Hello, everybody. This is Danny Johnson, retired Air Force veteran. I am from a little place called Stedman, North Carolina. And today, in our snippet, we're going to go through understanding whole life insurance. I know you see this a lot on TV. You see it advertised, you $9.95, whatever. That's just advertising for whole life coverage. But there are basically two types. And today, we're just going to go over what we call understanding whole life now coverage, or day one. Okay, it's very important. You get day one coverage that lasts you for your whole life. As long as you pay the premium, it's going to be there forever. It never goes up, never goes away as long as you take care of your premium. Okay, usually to 121. I think they got that out of the Bible, as a matter of fact. It's used for basically burial, final expense, last expenses left to loved ones for like a grandchild or a child for college. Most ages are between 45 and 85, but it can be issued at 14 days all the way up to age 90. So that's key. The younger you can get a child covered, the better off you are, because you never know. Again, death has no holidays, and I'm not trying to preach it to you one way or another, but it's better to be prepared than not. And I've delivered some policies for some kids, so it's sad. But here's the thing: to get day one coverage, must have reasonably good health. Note, diabetes is considered good health if you don't have problems with your eyes, your kidneys, or nerve damage. And there's some companies that do what we call modified, but that's the basics. These policies can build dividend income also based on your age and health. Some people take out very large whole life policies and it builds dividends. So it's got some perks to it too. Coverage for children in good health from 14 days up to 17 can be paid up on some policies at 10 years. So what does that mean? So if you've got a 14-day-old and they're in good health all the way to a 17-year-old, there are some policies out there that you can pay for 10 years and you're done. They're covered. I have those on my grandchildren, and that's in case of something happens and in the future. So, but here's the good thing about it: if you've got a 14-day-a-year-old and they turn 10 and they've got a 25 or $50,000 whole life policy paid up, and you're done. Okay, it's pretty cool. Simplified issue: there's no medical exams. What does that mean? They look at a medical information bureau report and look at the RX report, and they base it off of that. So there's some questions you got to answer. Now, this policy can set aside mortgage payment protection for 6 months to 3 years. Why are you saying that, Danny? I'm glad you asked. Here's the reason why. Some people's health is reasonable, but it won't qualify them for what I call a term policy. So one policy does not fit every occasion. So what you do is you get a 10 or 15 or 20 or $30,000 policy, you pay on that, and then if somebody passes away, they've got anywhere from 6 months to maybe 3 years to take care of some bills, get a house back on the market so they won't lose the home or lose the equity. This is my snippet. Again, understanding whole life day one coverage. Take care. You have a blessed day, and God bless you. Take care.